Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 4th August. Coming up on the show, the markets look set to regain their footing after last week's tariff announcements. The chances of a Fed rate cut next month are on the rise. And OPEC Plus raises oil production quotas to a 2-year high. So grab your coffee and let's own the morning. OK, we kick off the things you need to know by looking at the US futures markets. Now, as you can see, it looks like a positive start to the trading week after Friday's pretty dismal performance. In fact, globally, stocks were on the rise as investors in the main seemed to shrug off the impact of President Trump's tariff announcements last week. Only the Nikkei going against the grain there. European stocks haven't bucked the trend in early trade this morning either. The FTSE 100 getting an extra boost from banking stocks after UK lenders won a major reprieve in pivotal UK car finance case. The US president announced the new tariffs late on Thursday last week. The likes of Canada, Taiwan and Switzerland all hit with hefty levies. Swiss stocks today have taken a bit of a hit after being closed for a public holiday on Friday. However, in the main, it seems that a level of certainty when it comes to tariffs has returned to the markets. The next thing you need to know, and is another major factor today when it comes to what's driving the markets, is expectations are rising for a rate cut in September. Why? Well, investors are becoming more hopeful of a Fed rate cut next month following Friday's dismal jobs report. That jobs report saw traders rush into treasuries despite worries about the inflationary effect of Trump's tariffs, which have kept the majority of policymakers in hawkish mode. In early trade, though, treasuries have pared some of last week's gains, the yield on the 10-year climbing around 3 basis points. Meanwhile, the dollar is pretty steady this morning. Overnight index swaps signal more than 80% odds of a rate cut next month, while fully pricing in one more cut by year end. Some market watchers are even anticipating the Fed may cut rates by 50 basis points. That's twice the regular amount. Also this week, expect the president to name a new Labour statistics boss and fill an open seat on the Federal Reserve Board. Moves that would see him tighten his grip on US economic data and policy making. On Friday, he sacked the commissioner of the Bureau of Labour Statistics following the release of that pretty dire jobs report. The president also indicated he had, quote, a couple of people in mind to replace outgoing Governor Adriana Kugler, who quit on Friday 5 months before her term was due to end. And the final thing to know about before the opening bell rings is that it's yet another busy week of corporate earnings. None of the Mag 7 reporting this week, but the likes of Palantir, Disney and Eli Lilly are all on deck. Well, let's take a closer look at those big earnings results out this week. Here's my colleague, Josh Lipton, with all the details.
Time now for what to watch. It's a big week for earnings, so let's start there. We're going to be hearing from a lot of prominent names, including Palantir on Monday, AMD on Tuesday, and Disney on Wednesday. Palantir announced results for second quarter. Analysts expecting Palantir's U.S. commercial business to post strong results for the quarter, but also see it growing more slowly overseas as it faces new competition in government contracts from companies like OpenAI, Google, and xAI. And moving over to the Fed, we're going to be getting some Fed commentary on Thursday from Atlanta Fed President Raphael Bostic. It's coming after some shakeups at the Federal Reserve. Fed Governor Adriana Kugler announcing on Friday her resignation effective August 8th. The Fed holding interest rates steady at Wednesday's FOMC meeting. Fed Governors Christopher Waller and Michelle Bowman disagreed with the decision, preferring to cut rates by a 1/4 percentage point. Fed Chair Jerome Powell saying in his post-decision press conference that no decisions have been made on a potential September rate cut. And taking a look over at the monthly consumer credit data for June is coming out on Thursday. Economists forecast that number to rise to $7.1 billion, suggesting consumers are taking on more debt, which could signal more confidence in the economy.
Well, for market movers, we're going to focus on oil. The OPEC Plus oil cartel said on Sunday it would raise production by a further 547,000 barrels a day from September, fully reversing its nearly 2-year-long strategy of propping up prices by holding huge quantities of crude off the market. The decision marks the end of an agreement that began in January 2024, under which 8 members, led by Saudi Arabia, Iraq and the UAE, voluntarily cut their daily output by 2.2 million barrels, aimed at concerns about the rise of EVs and sluggish oil demand growth in China. The progressive restoration of supplies over recent months has been widely seen as a concerted push by the cartel to reclaim market share. Oil prices fell in response to the announcement, but have remained pretty steady in early trade today. Traders are weighing the possibility that Washington may move later this week against Russian oil flows, including buyers such as India, in a bid to raise the pressure on Moscow to pause the war in Ukraine. Meanwhile, oil giants Chevron and Exxon released earnings reports on Friday that even though both beat expectations, profits at both fell to a 4-year low and both saw their share prices falter. Today, both stocks look relatively unmoved by the OPEC Plus announcement. On Tuesday, it will be the turn of rival BP to release its results. Its shares are on the rise today after it revealed its biggest oil and gas discovery in 25 years after drilling a successful well in a field off the coast of Brazil. This find comes as BP shifts its strategy to place greater emphasis on oil and gas and less on renewables. The focus for tomorrow's earnings will be the progress the firm is making on a $5 billion cost-cutting plan. Activist investor Elliott Management has been increasing the pressure on the energy major to rein in operating expenses more aggressively. The US hedge fund has a 5% stake in BP. Now, BP is looking to reach its savings target through a combination of streamlining supply chains, job cuts, exiting parts of the business such as hydrogen, and divestments, including selling BP's onshore wind assets and spinning off its offshore wind arm. We'll bring you BP's earnings report on tomorrow's show. Make sure you don't miss that. OK, it's time for a break, but coming up, a look at how ETFs have evolved and what they can offer investors. That's next on Morning Brief Market Sunrise. Welcome back. Now, exchange-traded funds, or ETFs, have changed the investment landscape over the last 30 years. They offer more flexibility and tax efficiency for investors. Yahoo Finance's Jared Blickry has a closer look.
Earlier this week, we took a look at ETFs versus mutual funds. And today in Stocks in Translation, we're going to explore 2 of the earliest ETFs, SPY and the QQQs, and how the asset class has evolved over the last 30 plus years. And first, a recap of the definition of an ETF. These are shares that trade like a stock, but usually represent a basket of assets tracking an index or a theme, though there are exceptions recently. Unlike mutual funds, which trade only once per day after the close, ETFs can be traded bell to bell like a stock. Now let's take a look at a timeline that begins in 1993. That was the birth of SPY, and that's what this chart up here is representing. Now this came to pass in early 1993, and it was kind of the holy grail because there had been attempts before to create an ETF, but they had been struck down by the courts. So in 1993, SPY is born, and now you can trade the entire S&P 500 just like a little stock with a low amount of money. Then a few years later, in 1996, we get open-end ETFs, and this is different from the way SPY was constructed. It was a closed investment fund. That makes it more difficult to swap out the shares. But even though these open-end ETFs got the green light, not all ETFs would use them in the years to come, and I'll come back to that shortly. Now, in 1998, at the end of the year, we got a very tax-friendly ruling from the SEC, and this has to do with the way that shares are sold or swapped in. Now, in a mutual fund, if you want to change out a share, then you have to sell the stock, and it actually creates a tax event at the end of the year. So you could get a bill for that, but not in ETFs. They can usually avoid that. So that was a critical distinction that made ETFs more favorable than most the mutual funds when it comes to those taxes. Now let's take a look at the Q here. This launches in May or March of 1999. Kind of a big day there because now you could trade the NASDAQ 100 as the dot-com bubble was still going up. It would have another year or so, and then we would see that nasty fall. By the way, the NASDAQ 100 ETF QQQ, that would lose about 82%, and we'll get to that stat in a second. But fast forward a few years, and in 2004, we get GLD. This is the first physical gold ETF, and the first time we've had a commodity in ETF form. Quickly thereafter, we would get SLV for silver, but then we get others for wheat and coffee and all kinds of different things, all kinds of different derivatives. And then a few years later after that, we got active ETF managers in the game. So now this is kind of like hedge fund territory. This came in 2008, but by the time we got into the mid-teens, Cathie Wood would use this for the ARK Innovation Fund, and she would actively manage that ETF, kind of like a hedge fund. Now we're going to skip forward a few years in time, and let's see, we just did that one. Here, we're going to go to the end of the teens here, and we have semi-transparent ETFs approved. So for some of these active funds or actively traded funds, if you wanted to protect your secret sauce instead of disclosing all your holdings at the end of the day, this would allow you to do that, and that would kind of pave the way for some more active ETFs in the coming years. We still have mostly passive, but it is an improving game for the active managers. And then taking a look just a short time later, we have the ETF rule arrives. This was kind of like the holy grail for ETFs, because previous to this, it was very difficult to get these things launched. You had to apply for regulatory relief, and this just streamlined the entire process. And this would really explode the ETF volume, the new ETF launches over the next few years. Finally, not finally, but almost to the end here, we got 2022 single stock leverage ETFs and also inverse ETFs. Those would join the game. Tesla, Nvidia, Broadcom, you name it. We now have, I believe, close to 100, if not more of these. And these are tracked by our friend Todd Sohn over at Strategas ETF Management. He comes out with some interesting figures each week on that. And then in the beginning of 2024, we got those spot Bitcoin ETFs. Prior to that, we had Bitcoin ETFs that were based on futures, but these would really allow investors for the first time to track the actual price of Bitcoin in their 401ks and just have access to it like any other stock. And the last item here, this is not a big sweeping, but this is not a big sweeping change to the industry, but Invesco is asked to convert the NASDAQ 100, and that's its Qs fund, tracker from a fixed unit investment trust to an open-end ETF so that the firm, not just the custodian and NASDAQ, can share in the fees. And this goes back to that early decision in 1999 to form it as a unit investment trust, which is a closed-end fund instead of an open-end fund. At the end of the day, Invesco has left hundreds of millions of dollars on the table because of that, but we'll get to some details on that in a second. Next, I want to show you the differences between SPY and Qs over the year and some of the different stats that have evolved. So we've already covered the launch dates, but look at the total price return of SPY. That's up over 1,300% since 1993, and since 1999, we have the Qs up 1,007%. When it comes to the worst sell-off, that would be the global financial crisis, minus 56% for SPY. And then, I think I cited this before, 83% in 2000 to 2002 for the Qs there. That was the dot-com bust. And if you take a look at the management fee, basically half for SPY, that of the Qs, 0.0945 if you're going to add a few decimal points. And the volume on SPY, I believe it's still the heaviest traded ETF in the solar system, 67 million shares per day versus 40 million for the Qs. And then if you were to convert that to a dollar amount, that's 42 billion every single day, and about half of that, or 23 billion for the Qs. Now, the shareholders of the Qs, they're going to vote on October 24th whether to modernize the ETF. And if they say yes, then the trust becomes an open-end fund, letting Invesco keep most of the management fee, worth over $600 million a year based on today's asset base. So if the shareholders give the green light, the changes could go into effect in early 2026. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found every Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
Amazing analysis there from Jared, as always. Well, coming up, we'll take a look at some of today's trending tickers and give you the news behind the moves. That's next on Morning Brief Market Sunrise. Welcome back. Now it's time for some trending tickers. Okay, today we're watching BYD, Opendoor and Figma. First up, BYD. It's reporting a drop in July deliveries. The Chinese electric vehicle maker ending a 16-month growth streak as competition heats up. Still, the stock is up more than 25% year to date. The company saw both production and sales hit record highs in the fourth quarter of 2024. Now remember that BYD is the biggest Chinese rival to Tesla. Okay, next up is Opendoor, and it's climbing ahead of second quarter results due out on Tuesday after the closing bell. The real estate company propelled into the spotlight over the last month as it became part of the meme stock frenzy. The stock soaring more than 250% over the last 30 days. Last quarter, Opendoor beat analyst revenue estimates and issued stronger than expected guidance. Plus, we're keeping an eye on Figma. After its public debut on Thursday, the stock pulling back slightly in the pre-market after surging 250% in its first trading day. Shares closing at $115.50 each on Thursday, more than tripling the IPO price of $33 apiece. According to data compiled by Bloomberg, Figma saw the largest first-day pop in at least 3 decades for a US traded company, raising more than $1 billion. Figma is used to design web and mobile application interfaces. That does it for trending tickers. You can track the best and worst performing stocks with Yahoo Finance's trending tickers page. Okay, now President Trump fired the Bureau of Labor Statistics Commissioner following Friday's weaker than expected jobs report. Yahoo Finance's Josh Lipton spoke to Joe Brusuelas, RSM chief economist, about what it means for investors. Take a listen.
This is really unfortunate. It's similar to the attack on the Federal Reserve's independence. It just undercuts the veracity of the data. And I don't mean that in they're fixing it. What I mean is that the federal government has made a decision to not invest in the collection of the data. When you do that, you're going to have larger revisions. There's going to be more of them, and it's going to cause more volatility across financial markets. So this is a classic lose-lose proposition here, Josh.
The question also then, Joe, immediately is who would then step in and take this job, knowing that this could be the outcome?
Well, I don't know. I don't know anybody who'd be willing to step in and take that job. That's the problem. No one's going to be next up because they're going to think, well, when the business cycle finally ends, and business cycles tend to expire after long periods of time, you're going to get fired for it. So why take the job, right? And that in a nutshell is the problem. Is it just undercuts any idea of confidence in these data. Now, I want to be fair here. Revisions to economic data in general and the jobs data in particular have been an issue for decades. You know, for a long time, the plus or minus on jobs day was 50,000. Now it's 100,000. Well, you know, again, if you make less of an investment in the collection of this critically important data, you're going to have a larger standard error, right? And that's just where we're at. So I don't see this situation getting better.
Okay, for today's call of the day, we're looking at Berkshire Hathaway. The company reporting a decline in second quarter operating profit as it warns about the impact of President Trump's tariffs. So is now the time to buy the dip? Here's what Bill Stone, the Glenview Trust Company's chief investment officer, has to say about the stock. Take a listen.
I just think of it as Berkshire's kind of the perfect stock to own when you're worried about the world for 2 reasons. One is this massive amount of cash they hold, but 2 is because you expect they should be able to take advantage of it if in fact you get big sell-offs in the market or dislocations. When you're not as worried about that, like we haven't been here for the last quarter, you're not as excited about Berkshire Hathaway.
Well, let me ask you, Bill. Buffett is stepping down. Greg Abel taking the reins. As a shareholder, how do you feel about that changing of the guard?
Well, you can't, follow the goat and expect to feel good about it. I do think Greg has shown up as a very good operator. In fact, I think you could argue probably a better operator than Buffett because, frankly, Buffett doesn't want to spend his time operating businesses necessarily or getting into the weeds of them. So I think he's very competent, and for a company that is already so large, I think there's already been some distinct benefits from having him already take on a much larger role. Again, would I rather Buffett was going to live forever and keep running it? Of course, but I can't have that.
Do you think this weakness, Bill, in the stock, buying opportunity in your opinion?
Yeah, I think it's back to a point where you can feel pretty good about owning it. We're back down to 1.5 times book, still maybe a little rich. That would, the way I kind of think of it is I would suspect we won't see any buybacks, stock buybacks from Berkshire Hathaway. I kind of frankly just try and, essentially I get more interested as I suspect they're getting more interested because they're the ones that know the intrinsic value certainly even better than I do. But I don't think you're crazy here. When it got up to like 1.8 times book, it was expensive stock, not that it's a reason to sell it. It's just probably was a reason to slow down owning it. I think now you can be back to at least slowly grabbing some as you go.
Okay, let's get a final check on the markets. Now, stocks clawed back some of last week's steep losses as equity investors pinned their hopes on the Federal Reserve to ride to the rescue with interest rate cuts following Friday's dismal US jobs data. The Nikkei in Japan, though, there was the big fall. Declines were led by financial names and export-oriented companies such as automobiles as the yen weakened against the greenback following that speculation of rate cuts by the US Federal Reserve next month. Turning it over to European markets now, it was a similar picture here. Investors seemingly shrugging off the tariff announcements on Friday, though stocks in Switzerland were sharply lower, as you can see there. Remember, the market there was closed for a public holiday on Friday. The president hit Switzerland with a 39% levy. Now, the UK's FTSE 100, as you can see, is getting a bit of an extra boost from financials after lenders won a big car leasing legal case on Friday. Now, on Wall Street, it's all green. That suggests a bit of a recovery after Friday saw the S&P fall by more than 1.5% and the Nasdaq by more than 2%. Keep an eye out on earnings out later. The highlight after the closing bell is likely to be Palantir. And now on to Bitcoin. It's little change this morning, but somewhat off its recent highs of over $120,000. Investors perhaps steering away from crypto just for now. And we've got some breaking news coming in as well concerning Tesla. The board there, well, it's approved a new pay packet for Elon Musk, the CEO. It says it will grant him 96 million new shares worth around $29 billion. It's seen as a bit of a move to keep the billionaire entrepreneur at the helm as he fights a court ruling that would have voided his original pay deal for being unfair to shareholders. Remember, last year, a Delaware court voided Musk's 2018 compensation package. That was valued at around, well, just over $50 billion. They said that the Tesla board approval process was flawed and unfair to shareholders. I think it's really important to say that, Tesla is at a turning point as Musk, who's actually Tesla's largest shareholder, he owns around 13% of Tesla shares, is trying to shift the focus from affordable EVs to look at robotaxis more closely and humanoid robots as well. So he's positioning the company away from EVs more into an AI focus there. Anyway, that is time for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of live markets and your money all day on streaming and online. Coming up at 9 a.m. Eastern, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.